stock options risky? Most people say yes, some people say no, some people make a bunch of money, some people lose a bunch of money. So for 2024, I've been making roughly $20,000 per month with stock options. And the way that I do it, it's taken me years to try to refine my strategy. So most people starting out, they lose money just buying stocks straight up. But then when you try to do options on top of that, it's setting you up for failure because most people don't even understand the stock market alone. Then on top of that, they try to do options where options, they see them as these quick get rich schemes where they could put in $1,000 and 10x their money overnight. They've heard from their friend at work that they can make a bunch of money. Their friend did it, that friend did it. This person has a yacht, you don't have a yacht, so you're like, what the heck? So you want to YOLO your money in and try to make a bunch of money. I'm going to tell it to you frank right now. Most people will lose money in the stock market and most people will lose money with stock options. Why? Because you don't understand the stock market. You don't understand how options actually work. You don't understand the psychology of how humans trade. The stock market is not complicated. You don't have to have a super high IQ in order to make money in the stock market. You have to understand the flaws and the inefficiencies of how humans think and how they operate. You have to understand what happens when the stock goes down for the typical person, how they freak out and want to sell. You have to think about when stocks go straight up for the typical person, how they want to YOLO in and buy more. So this video right here, I'm going to lay the foundation for the most common mistakes that people make with stocks and stock options and what to do about it. So you're probably wondering, why should I listen to you? Well, this is my Schwab trading account and I haven't added money to this Schwab trading account in a few years. Total money that I put into this trading account is roughly $100,000. Currently, I'm 30 years old right now. So 5 years ago is when I started this trading account. I contributed a total of $100,000 in the last 5 years. And now this account is $830,000. Today alone, I made $7,500 and my 2-year return, I made over $557,000. So this bump right here, for example, this is when I sold stocks off of this account. So I didn't really lose money. I sell stocks off of Charles Schwab from time to time because I have 7 rental properties right now. And I usually put like 25% down. So if I buy a $400,000 house, I usually sell roughly $100,000 worth of stock so that I could go do that 25% down payment on that house. So there's a lot of volatility along the way in my trading account, but in my opinion, volatility is not risk. Volatility is good for me. That gives me a better entry price to sell options or to buy options. So I'm going to run you through my option blueprint super quick right here. There's a couple things I want to cover. There's definitely a few examples that I want to go over. So let me explain this stuff to you right now super quick, but I have a course that's coming out in the middle of October. I'm going to go into super detail on stock options, stock market investing, psychology of money, how I went from $0 to over $2 million in roughly 5 years. And I've done all that all before age 30. I've read hundreds of books. I've been through so many other seminars, so many other classes, so many other courses. I feel like my course is accumulation of all those classes, all those courses, all summed up into one place to show you the easiest, simplest way to make money in the stock market with stocks, with options, in a low risk way that actually works. It's been working for me. It can work for you. There's a link in the video description below for that. So if you're interested, definitely check that out. There's pre-launch pricing right now. If you get on the list, you'll get it a little bit cheaper versus other people after it launches. So if you're interested, check that out. So here we go. So when I feel like the market is undervalued, and of course that's the $1 million question as to know when is the market truly undervalued, which I break all of this down in my course. But yes, that's the $1 million question to know if the market's undervalued versus overvalued. When I feel like the market is undervalued, I will buy call options and I will usually sell put options. If I have a crap ton of conviction on a trade, I'll buy call options because there's more upside in the trade. But even if I still have a lot of conviction, but I want more flexibility with the trade, I'll usually go sell put options. And I sell a lot of put options on Triple Q, for example. There's other ETFs and individual companies that I do this for, but Triple Q is one of my most common ones. And usually when I sell put options, I'll sell like a block of maybe 10 contracts, sometimes for 6 months out, sometimes for 2 years out. It just depends, but I'll roughly try to get $10,000 to $20,000 in premium every time I sell that block of 10 contracts. So I also have a Discord where I share with you screenshots of my trading account, trades that I make in real time, my market updates. I usually do like an audio update every day after the market closes, just to give you a broad-based thing of what I think the market did and what I think the market's going to do going forward, and just things that I'm looking at. I think it's very helpful. A lot of people like that stuff. All right, so we talked about how I usually buy call options or I'll sell put options. So now the Greeks. So theta is time decay. So when you sell options, time decay works for you because if there's less time left in that contract, the contract value is naturally going to go down because there's less time for something to happen. But when you buy call options, theta or time decay actually goes against you because if you need the stock price to go up and it's not really going up, but you're clicking away times left in this contract duration, the contract is going to go down in value. So you really have to have a crap ton of conviction if you're buying call options. But if you're selling put options, you have a lot more flexibility. Now the delta is basically just a percent chance that the contract is going to expire in the money. So now we're going to go through some of my very basic parameters that I use to trade stock options with. This is very broad based. This is not a coverall. This does not apply to every situation. But generally speaking, I like to do contracts with a minimum of a 6-month duration, especially when I sell put options. When I buy call options, I do a bunch of call options that are less than 6-month duration. But when I do puts, usually the longer that I go, the safer that it is. And it definitely depends on what company or ETF I do that on. There's a lot more that goes into it than just doing a 6-month duration. Now, for example, on share price. So if I sell a put contract, maybe the share price right now is $400 a share. I give myself a little margin of safety, so I usually will sell maybe like the 360 put. But this all goes back to, is the market overvalued or undervalued? I only want to sell puts when I feel like the market is undervalued. That is the bread and butter. That is the $1 million question. Even if you sell puts and the price right now is $400 and you sell the 360, if you do that when the market is overvalued, the market can go way down. You could get forced to buy these shares. You could be screwed. You could lose a lot of money. But generally speaking, when the market's undervalued and maybe it's $400 a share, I'll sell the 360 put. Now, if you're buying calls, maybe the share price is $400. I'll usually buy maybe the 410 call because I want to buy it when it's out of the money, because the price that I'm paying for that contract, I get a little bit of a discount because technically when I'm buying the contract, it's worthless, it's out of the money. But of course, I'm only going to buy the call contract if I expect the share price to go up. So I love to get that discount right there for out of the money because of course, if I'm making a trade, I expect the share price to go up higher than 410. And one of my number one rules is you must have super high conviction. So in this account right here, I have a lot of buying power. If I want to make $200,000 selling put options tomorrow, I could do it. Is that wise? No. I have no problem sitting on my hands when I feel like the market is overvalued. Could I go sell call options maybe? Of course I could do that. Could I short the market? Of course. But the base of my portfolio, I have it in triple Q, VOO, and I have a little bit of Tesla stock. I have like 500 shares of Tesla. But the market often is inefficient. So when I feel like the market is overvalued, maybe I'll sell calls. But when the market is undervalued, I will buy calls or I'll sell puts. But just because I have the ability to make a trade, that doesn't mean that I'm going to go make a trade. You only want to make trades when you have high conviction. If you just go make a bunch of trades that are low conviction, you're probably going to lose on a bunch of those trades. But when I go make trades, I only do it on trades that I have super high conviction on. And when I do the trades big time. I don't go do little trades. I do huge trades usually. Another key thing for when you sell put options is you only want to sell put options on something you're okay to hold for the long run. Because remember, if you sell puts right here, for example, maybe the current price is $400, and if you sell the 360 put, but it goes below $360 per share, you are forced to buy those shares for $360. So if you do that on a quality company, maybe like Apple or Amazon, the share price is probably going to recover if it dips below $360. But if you do that on a garbage company that's maybe going to go out of business, you might never recover that money and you could lose a crap ton of money. So you only want to do this on high quality companies or ETFs that you are okay to hold for the long run. And another thing right here, I love selling puts on triple Q when the market corrects down because I'm getting a better price and I want to get stuff at a discount. All right, so let's hit it on a couple examples super quick. So let's say you're bullish Apple stock. What are you going to do? You could buy calls or you could sell puts. So for this example, let's say we're going to buy calls. So if the current price is $200 and you set your strike price at $200 also, but maybe in 1 year you expect the price to go to $250. So if you're correct, you're going to make $50 per share because your strike price is $200 and you expect it to go to $250 in 1 year. So you make $50 a share. And remember, every options contract is 100 shares. So if you do $50 a share times 100 shares, you can make $5,000. But remember, you don't get these contracts for free. You have to pay for the contracts when you buy them. So you paid $800 to buy this call contract, for example. So your total profit would be $5,000 minus $800. You got $4,200 profit right there. Now let's say you're bearish Apple stock. So you could either buy puts or you could sell calls. But for the basic example, let's say that you buy puts. So if the current price of Apple is $200 a share, you set your strike at $200 a share also. And if you expect the price in 1 year to go to $150 a share because you're able to sell your shares for $200 a share, even though they're only worth $150 a share. So you're in a profit by $50 per share times 100 shares, you're up $5,000. But in this example, you paid $800 to buy the contract, so total profit's $5,000 minus $800. You made $4,200. Now for the more complex examples, let's say that you want to sell puts. So the current price of Apple is $200. Let's just say for the example, you set your strike price at $200 also. Expected price of Apple in 1 year is $210. So you have a little bit more flexibility on this situation right here when you're bullish versus this situation right here where you're expecting the price to go from 200 to 250. So when you're buying calls, You're like, oh, I think it's going to go from 200 to 250. But when you sell puts, maybe I only think it's going to go from 200 to 210. So when I sell this put contract, I just collect $800 in option premium and it's done. But remember, my upside is capped when I sell puts at $800. I can't make any more than $800 because that's just a premium that I receive by selling a put. But on a calls right here, I can make a lot more money because the share price can go higher than 250. But here's the issue with buying calls versus selling puts. So if I buy calls, the only way that I make money is if the stock price goes straight up. I need the stock price to go up quickly because I have that time decay working against me. So if the stock price does not go up quickly, I will probably lose money. And remember, if the share price is 1 penny below what my strike price is when I bought those calls, that call contract will expire worthless, so I will lose 100% of that money. But when I sell put options, when I feel like the market is undervalued, maybe the current price of something right now is $200 a share, I will maybe go sell the 170 put. So if the market goes up, stays flat, or just stays above $170 per share, I will make money. So selling put options, yes, you'll make a little bit less money per trade, but selling put options is like hitting first base hits all day long. Usually you could hit those first base hits. But when you're going for the call options, you're pretty much trying to hit home runs every single time, and you're way more likely to strike out when you buy call options versus selling put options. Now, I do use call options and put options quite a bit in my portfolio, and that's one of the main things that contributed to my huge return in the last 5 years. Remember, I put roughly $100,000 of total money into this account, and now it's $830,000. Yes, I made good money on the shares that I own straight up, but the stock options make me a lot more money than owning the share straight up. So if you're interested in learning from me, the stock market, stock options, psychology of money, I even have a tax section, banking section, efficiency sections. The course that comes out in October of 2024 is going to help a lot of people, I think. I'm building the course that I wish was there when I started out because there's no other course that I've been through so far that is going to be as thorough, as clear, and actually gives you an actionable thing to do at the end of the course. So the goal is when you come out of my course, you'll know what stocks to buy, you know how much to pay for them, you'll know when things are undervalued, you'll know when things are overvalued, you're going to know when to use stock options, when to not use stock options, when to sit on your hands. Of course, nothing is guaranteed. There's risk to everything. So the links for my course, my free stock market blueprint, and my Discord is linked below. Check that stuff out. And if you made it this far, like and subscribe, and I'll see you guys later.